Hello, everybody. Welcome to our, now I guess this is our third webinar in this COVID-19 series. Really since all of our lives changed, gosh, about 6 weeks or so ago. And really my goal with these is to continue to update you and to really keep you informed. As our team, we're literally working harder and more hours than we have, if not ever, just on various webinars and conference calls with economists and health experts and also other top advisors. I'll say this too, if you have any questions, at the bottom of your Zoom app, there should be a place for Q&A, and I've got Carson in my office who's monitoring that, and at the end of some of my slides, I'll try to address some of those, or you can always email us. And I want to say, first of all, that I miss all of you. I miss our clients. I miss my team, and I know all of us miss our routines. And I miss getting haircuts. It's been a while, but no, I miss everybody. And this is hard. And I do believe that we're getting closer to some return to normal, whatever that means. But it's likely going to be a slower return to normal than any of us anticipated or hope for, and maybe it's even a new normal when we do get there. So we'll talk about some of that today. Some of you may have also seen right before the weekend that the government introduced a 3-phase plan to reopen and left it up to state. So it's kind of state by state at their discretion. And some states like Texas, I believe, are already starting to reopen this week. And so the question really becomes, what does that mean? Do people go back to, in restaurants and stuff, 50% capacity, 75%? Just because something reopens, we have to see what the demand's going to be, because as all of us know, we're a consumer-driven economy. But either way, it's very likely that our perspectives will have shifted some, which is never a bad thing. Hopefully, some of us have picked up some new skills or learned some new lessons and maybe even reached some tough decisions during this time that maybe we weren't able to find space to do so in full hustle mode. I know for me, a lot of times it's hard to slow down. If you know me, you know that about me. And I've said so many times over the last 10 years, gosh, if time would just stop and, so I had time to do, I don't know, X, Y, or Z. So here we are, right? Now, before we do the slides, it's important that I tell you how important it is to me that we never hide behind slides and charts and data, because after all, none of us know exactly what's going to happen. We don't know what's going to happen in the future because there's no such thing as future facts, right? Only the past we can use to reference. And you certainly do not need another COVID-19 expert, and I am certainly not that person. All you have to do is turn on your social media, turn on the TV, and you're inundated with that information. So here we go, and I'm going to chat more at the end after I go through some of the slides, and I'm going to try to bring it all together at the end and answer that question that I get all the time, which is, all right, great, David, great data, but now what do we do with it? What do we do now? So I'll make sure I get to that. All right, let me share my screen here. All right. Bear with me 1 second. There we go. All right, there we go. There's your compliance disclosures, lovely. I'm sure you're reading all of that. I'll give you a second on that. And here's an outline for today. So I'm going to go, as always, an economic update, talk about are we in a recession, which I'll address that and say that we are, whether it's been announced or not. The stimulus plan that just came out and kind of our recovery and what that looks like. Also, the importance of rebalancing portfolios and some other planning things that you can be doing or should be doing right now, and that we'll talk to you about. Okay, so let's look at this first slide. A lot of information. Hopefully you can see my red pointer here. But what's interesting, well, first of all, the market's down about 15 to 20%. I mean, my gosh, it's changing every day so fast. It does seem that it's calmed down a little, and people have seemed to adjusted are getting used to things now, right? And the panic has lessened, which translates to less of those 10% drops or gains in the market each day, and now we're kind of around those 2 to 5%, which are still big days in the market. But look how fast things have changed. At the beginning of the year, January 20, and then to now April, this was a survey of a lot of different advisors. It was a quarterly investment strategy sentiment survey that was taken in December and then again in March. And at the beginning of this year, people thought that there was a 5% chance that we were going into a recession this year. Now that's up to 93%. Favorite asset class was stocks or equities at 80%. That's dropped to 57%. And the target for the S&P at the year end was around 3,400, and now that's been lowered to 2,900, which still isn't terrible. And also look at this. What were you and all of us advisors thinking about and talking about at the beginning of the year? We were concerned about the election and the trade war, right? And now it's 74% are concerned mainly about COVID-19. So a lot of the talk and the worry about trade wars and election has subsided and been overtaken by COVID. And then if you look here, this basically, so most of the survey also shows that people believe that April and May is when COVID, kind of the plateau, is going to happen, which we're obviously coming up on that right now. And also the majority of people, so it's like 78%, and the majority of people surveyed believe that the S&P has already reached its bottom or is in the process, or we'll see it again in April before it starts to recover. Now, of course, our crystal ball, as I always say in the office, is always foggy, but I do agree with this mostly, with an obvious concern that, what if the virus picks back up in the summer and it could start a second wave of this mess. However, there are hopes of potential meds with the virus until a vaccine comes out that may bridge the gap and get people comfortable with getting back out. So that's really what we're looking for, right? And then this slide just kind of shows the cycle, and you can see where we are. I think the slide's already 2 weeks old, so it's already outdated, which puts us really here at the top of the mountain, kind of coming back down, where you can see China and Italy and other places are already on the way down. But again, we have to be aware of the risk of a second wave. Everyone's still hopeful with the potential plateau, plus the vaccine advances and testing, that just maybe we can start to taper down here in the U.S. And it's no surprise on all of our fundamentals for the last, we had longest expansion on record, 129 months, and you can look at all of the things, all the good news. Unemployment rate was at record lows, consumer confidence was high, jobless claims lows. All these things were really, really strong, and of course, now, unlike anything we've ever seen, unprecedented, the economy literally grinded to a complete and total halt, right? And how weird is it driving around with no traffic? I mean, Nashville to me now feels like it did when I moved here back in 2003. The restaurant industry, of course, is barely hanging on and adapting to carry out. The entertainment industry has come in most ways to a halt. And as if you're a client, a big part of our business is the music industry, and travel is almost non-existent. Big conferences are closed. Today was actually supposed to be the first day of our Raymond James National Conference, which I've gone to. I think this would have been the 18th year. So certainly unprecedented times for all of us. A lot going on in this slide. All I want you to just hear me say this. The definition of a recession is 2 consecutive quarters of negative GDP growth. That's different from a bear market, which is just the stock market being down 20% from its high. So we don't have enough data to technically say we're in a recession right now. It doesn't matter when they decide to label it. They likely will, but there's no reason to freak out over this term because the market has already priced in typically a recession way before we get the official name tag. And usually by the time it's deemed to be a recession in that second quarter of negative growth, the stock market has already begun its recovery. And that may in fact be where we're at now, with the bottom happening last month, the market slowly returning as we go into potentially that second quarter. So just keep that in mind. You're going to hear a lot about that on the media. And then this shows all the past recessions. This would be the first virus-induced recession, right? 70% of our economy is consumer spending, and 41 states are on lockdown. So past recessions have usually been because of elevated valuations in the stock market. Think like of the tech bubble back in 2000, 2001, or things like monetary policies or energy crisis back in the 80s. So this will be the first one, again, induced by a virus on its own. And we talked about the CARES Act last week, and with $2 trillion of stimulus, which was a record, many people have started getting their stimulus checks, and small businesses have been waiting on their paycheck protection loans. Some have already gotten that. That plan actually ran out of funding last week, which caused a lot of people angst and concern. But it looks like, and it may have already happened since I started talking, that Congress is going to provide more funds, potentially $370 billion more, to reopen that plan because it was exhausted within a matter of weeks. And other areas that are likely help in phase 4 that's likely on the way is help with infrastructure, hazard pay for frontline responders, potentially some debt relief for households and individuals, and funds for certain hotspot cities. So all of that's kind of in process. And let's look at, what's priced into the equity market. I mean, so we saw a 34% drop early on into this crisis, which was the fastest 34% drop in the history of the market. I think it was 22 trading sessions. That's unprecedented. And here we are. But you can also see that this drop, it's normal for recessions. What's not normal is how fast it happened. And keep in mind, stocks typically bottom 4 months before a recession. So this could, again, be all in line with normal if things start to pop back in the coming months. So just something to look at. All right, this slide, again, this just shows that I've showed many different charts over the past few weeks, really showing the same thing, that periods of solid returns usually come after these large intra-year drops, like the one we just saw, the down 34% right there, right? Gosh, a week ago, I believe it was almost 2 weeks ago, we saw the market gain almost 15 to 20% in 3 days off of the bottom. That's why this is so hard to do what? We've learned nothing else from our webinars class. What have we learned? Bueller, anybody? We have learned that we don't try to time the market. We just add more money if we can after these big market drops. This is so important. We do not want to miss the rally on the way up. Think if you pulled out right before that 15% pop a couple of weeks ago. It's very, very hard to do that. Cannot stress that enough, and I will do it on every single webinar, and you'll get tired of it, but that's okay. All right, let's talk about rebalancing for a second. This is a big deal. So there are a lot of major institutional investors that are likely going to start and have already started a couple of weeks ago rebalancing their accounts. What that basically means is, think of it this way. If somebody had a 70-30 portfolio, 70% stock, 30% bonds, that likely fell to about 60-40. So that 70% in stocks is probably now 60% because the stock market's down. So when they go back to their target allocations, they are in essence buying 10% more stocks. Well, this translates, you can see here, to potentially $2 trillion in equity flows coming back into the market. So even if investors aren't necessarily feeling excited or bullish about the market, the simple act of rebalancing is going to inject a lot of money into the stock market. Again, potentially that would be a great tailwind for the market to continue to rebound, even in the midst of bad news, right? And this slide really just shows the takeaway here is that over time, a rebalanced portfolio can provide a similar return with less risk. And it's really just a time-tested principle that we subscribe to. And we did it earlier this year for all of our client portfolios before COVID-19, because that's something that we do annually. But we've also built in some tweaks into our models, and we plan on rebalancing again here sometime soon. And of course, if you're a client listening today, you'll be hearing from us, as you know, as we do that. And we have spent a ton of time getting research from our investment committee and large institutions like BlackRock so that we can do this effectively and efficiently. Now, I went over this in my last couple of webinars, some planning opportunities. And so feel free to call me or email the team If you want to review this specifically for you, of course, because these are not all black and white issues. There definitely is some gray here. But Roth IRA conversions, again, the thought there is basically if your Roth IRA or if your IRA has dropped in value from $1 million to $800,000, you could move some of that or all of that into a Roth IRA and pay taxes now at a lower value. And then when the market comes back, which we believe that it will over time, you will have locked in taxes on a lower amount for a tax-free account that is now a Roth IRA. That's the thought process there. A lot of other things to take into account, but definitely worthwhile. And then tax loss harvesting, this is where you sell a security that has a loss and you basically, we replace it with similar securities so that we keep your asset allocation and your risk the same, but we're able to recognize that loss and use it against other gains you may have from other passive activities like selling a piece of land or real estate, other investments. And we can use $3,000 of that loss against your ordinary income and carry that forward forever until we use it. So that's something we've already been doing. We've done that for most of our clients over the past few weeks. It's a very manual and tedious process, but very valuable. And then retirement plan contributions, think about, you can still make your 2019 IRA contributions until I believe it's July 15th, which is when tax deadline was expanded to or moved to. And then you can also go ahead and get ahead for you overachievers and do 2020 contributions, right? And then we talked about a webinar, I think it was the one last week, the CARES Act, which basically said all required minimum distributions and for beneficiary IRAs are now waived. So you do not have to do those this year. Now, before I kind of close up and go over some final thoughts, Carson, do we have any questions?
Yeah, there was one question. So it's pretty interesting, and I know this isn't a direct answer, but I'll let you answer it, David. When a market hits a bottom and it starts to come back a little bit, does the market always retest those bottoms, or does it depend?
Yeah, that's a good question. It depends. There's not really an always when it comes to a market, other than the closest would be, has the market over time always come back and reach new highs? I could say yes to that. But will the market retest its bottom? It is, what I'm hearing is more of like 50-50, which I know really helps, right? But 50% chance we already hit it and we're going to maybe kind of, we hit the bottom and now we're kind of in this, we started here, here's the bottom we hit, we're kind of in here, that maybe we kind of hang out and zigzag for a while until businesses reopen and we get the economy going again. The other 50% think that we may test the lows we saw back in March temporarily, but even then there'd probably be a pretty big snapback. What do I think? I think we've probably tested the lows. I think we've probably already seen the lows, and we're going to kind of hang out in this kind of weird space for a little bit longer until there's substantial good news, meaning a vaccine, or we get the economy going again and we don't hit a second wave. So the next couple of months, I think, are very important. So that's my way of saying I don't know, but hopefully that provides a little bit of color to that. Carson, any other questions? That was a good question.
Yeah, there's a couple more. Since we're okay on time, I'll go over a couple of them.
Sure.
Let's see. So one, is there any sort of attractiveness in commodities like gold, silver, or precious metals in times of market volatility? I know that's, again, probably not a direct answer, but just from your experience as an advisor for almost 20 years, where have you seen precious metals play a part?
Yeah, and typically I'll just use gold as the example because I've done whole presentations on this, but gold a lot of times is a fear-based investment, meaning during times like 2008 or after 9/11, people will run to gold and the price of gold will run up, and it becomes a trader's game because long-term, over the course of 20, 30 years, historically the returns in gold and gold has been up there with the stock market per se, so we're not a big fan of it long-term. But during times of volatility, for those of you that are traders, people have bought gold, at a bottom, rode it up, and then got out of it at the right time. Very hard to do, and I know more people that have lost a lot of money playing the commodities market. So I tend to stay away from it or advise it's somewhere between 2 to 5% of the portfolio tops, or if somebody just owns gold as like a collector's item for fun, they have a couple of bars of gold, and they're safe. That's one thing. But, when gold is bought as a fear-based investment, thinking, the question I used to get was, gosh, what if the economy goes to zero and the dollar's worth nothing and there's no economy? My answer is, what good is a bar of gold going to do unless you're going to hit somebody over the head with it, right? I'd rather have bottled water and food and other things. So I don't like fear-based investments, but I'll step off my soapbox there. That's a good question.
And then the last question, so our thoughts for our portfolio's rebalance. What are our current thoughts, or what's some of the strategies that we're thinking for our next rebalance?
Sure. I should let you answer this because you know the answer. But I'll say a couple of things, like we're lowering, we already over the past year, we're kind of de-risking the portfolio, taking a little bit into more value stocks. We're going to lower international a little bit more. We were already lighter on international than U.S. We just don't see the research showing how international is going to fare better than the U.S. out of this recovery. So we're going to continue to go heavier U.S. We're looking at all the credit risk in our bond portfolios. And then again, and then also looking for ways with managers and index funds, how can we continue to lower costs in the portfolio and find more tax efficient investments? So a lot of it's simple tweaks, because we've already been proactive over the past year. This is not reactionary. This is strategic, and us just trying, again, to reset client portfolios since we had such a massive and quick move to the market. So more to come on that for sure. Thanks, Carson, for those questions. I'll kind of start to wrap up. Let me say this. Well, hopefully that was useful. We love what we do. I hope that's apparent, even when it's hard like it is now. No one likes to lose money, even if it's just on paper and it's temporary. I can assure you to a fault that I feel the weight of this for all of our clients. And I'm very thankful, though, that we followed these strategic, time-tested money management principles, and therefore we didn't get caught up in the major losses in areas like energy. Same thing I said in 2008, that I was thankful that we weren't involved in the subprime investments and didn't have to tell clients that we're sorry. So I like kind of staying in that middle lane and doing what kind of wisdom has taught us. Many of you have even told us that you were pleasantly surprised. In fact, I had 3 emails this weekend saying something to the like that, gosh, that we were only down, X percent. We thought it was going to be a lot worse. So we just appreciate your perspective and your patience and the trust that you've placed in us to help you get through this pandemic and just back to prospering again on the other side. We have to protect our minds, right? You are what you feed yourself, and that's so important. If you talk negative to yourself and you consistently read negative information, you're going to feel pretty bad, and that's a fact. So just try to choose who and what you follow. And, I know I'm getting inundated with people and economists and new investment opportunities, right, and products every day. And we've just learned to stick with what's worked, over the long term and not chase fads or things that come out right after or during chaos. And I remember back in 2008, I saw this, a lot of products coming out. And a lot of times those products come out at the worst time and they don't work during a recovery. So that's likely to happen again, in my opinion. And remember this, there are 3 parts of spending in your budget. There's your needs, there's your wants, and there's your wishes. And so let's evaluate those right now. And I'm having this conversation with a lot of clients. Maybe last year the Italian cruise was a need, and now it's on the sidelines, right, for a while, and that's okay. It's temporary. And we will revisit those kind of things, and let's buckle down a little during this time, not out of fear, but because we just want to be smart and a little bit strategic until things get back to a better place. And one of the best reminders that I have seen in a long time was to us as advisors, saying our role as financial advisors is to help clients minimize regrets, right? To help you avoid those costly emotional mistakes like selling at the bottom and missing the rally. That's our most important job. And I do think there is more volatility ahead in the coming weeks in the market. We are not in the clear yet. So make sure your cash reserves are strong. Turn off the TV and remember that this is a long-term plan that we have built. It's not a plan that we need to change weekly or we would drive ourselves nuts. That is a fact. Just let us help. We are here for you. That remains my team's commitment, and I will see you again on an upcoming webinar, and call us. We miss you. Hope to see you face to face, and hopefully in the next month. Thank you so much.